Good afternoon, ladies and gentlemen, and welcome to the show. Really glad to have you guys here. Now listen, there's been a big game changer happen in this last week. It's almost like a black swan, except maybe this is a white swan. This is a real game changer, what's just happened, because it's a lot of money. Now, going back to quantitative easing, the Fed was putting quantitative easing at its peak. The Fed was putting $80 billion a month, once every 30 days, $80 billion a month into the world's financial system to support the economy. But we always talked about how this time it's going to be an awful lot more needed, and the Fed's going to have to pull out the stops. Well, listen, guys, they're pulling out the stops, and this is a game changer on many levels. It changes my fundamental outlook for the United States economy going into the months ahead. So we're going to have to step back and take a real look at what they're doing. Let's get the chart started right here, and let's take a look at what they're doing. New York Fed to pump $75 billion into money markets daily. That's about 26 times, if my math serves me right, it's about 26 times as much as quantitative easing was when quantitative easing was at its peak. So it's quantitative easing times 26. 26 times greater, because they were putting $80 billion a month into the market. This is $75 billion a day. I mean, we're talking 10 days, $750 billion in every 10 days. This is game-changing amount of money that's coming in to the marketplace. Now, this money's not going to go to the people directly and into the economy directly. This money is going to filter its way through indirectly into the economy. So it's going to take a while for the effects to be felt of this money that they're putting in there right now to support the overnight window. Now, I'm going to tell you guys, the repo market, I'm going to tell you what it basically is. It's basically the biggest pawn shop in the world. The banks come in. Instead of, you know how you guys go to a pawn store, or I've been to a pawn store, everybody's been to a pawn store, there's always been some point in your life where you just run out of cash. So you go into the pawn store, you take your gold ring, you slide it across the counter, he eyes it with a little eyeglass thing, and then he says, I'll give you $100 for it, to pawn it. Right? And you say, okay, and he holds the gold ring as security. When you bring him back the money he gave you plus interest, then he slides the ring back across the table back to you. That's how a pawn shop works. Basically, the repo market works exactly the same way. We're talking about much larger amounts of money. So, the bank comes in. Instead of sliding the gold ring across the table, they slide securities or treasuries across the table. In return, they're given the money. The money! But the problem in the repo market was that it's like the pawn store owner, if he ran out of cash, if he started to get low on cash, what he would do is he'd raise the interest rate that you have to pay the pawn store higher and higher, because he doesn't have enough cash, so he figures, I'm going to hang on to my cash, I'm running low on cash, so you come in to pawn your ring, he'd charge you a higher percent rate of interest, and he'd be like, take it or leave it. Well, they did the same thing. They were running out of cash in the repo market, so they raised the interest rate of the repo market, right? And it went almost up to 10%, the overnight rate. So the feds came in and gave them a whole big buckets and buckets and buckets cash up the yin yang. So now the repo, of course, the rate comes back down again, right? So that's what's going on. But the effect of what's going on, the amount that's going into the repo market of this cash or liquidity, says New York Federal Reserve Bank said Friday it will inject billions into the U.S. financial plumbing on a daily basis for the next 3 weeks in an effort to prevent a spike in short-term interest rates. The Fed will offer up to $75 billion a day in repurchase agreements exchanging secure assets for cash in very short periods. Through October 10th, it said in a statement. In addition, it'll offer 3 14-day repo operations of at least $30 billion each. It says banks have been struggling in recent days to find the cash needed to meet reserve requirements. So basically what was going on here is if they hadn't have stepped in, the banks would have all melted down, just like in 2008. We've almost had another meltdown. This went undetected within the system. This is an emergency measure. But it's going to change everything. So you guys are probably asking to yourself, well, how's all this money or liquidity pouring into the repo market going to change everything? Well, what happens is, we were headed straight toward a recession. That was, I tend to think that it was going to hit before the end of this year, to tell you the truth. Now, all the other countries on Earth are sliding down that same slippery slope, but they're not getting all of this injection of cash, are they? like you know, now they're trying. The European Central Bank, they went back to printing money too, you know, but they're going to only print 20 billion euros a month. Well, that's a drop in the bucket. That ain't going to cover it. Europe's going to slide into an economic recession because that's not enough. Instead of 20 billion a month from Mario Draghi and his team up there at Brussels, they should be dumping about 800 billion a month or 5 trillion a month if they want to stop the train that's coming. Because if you let that train get too much momentum, then try and slow it down. Then try and put the brakes on. It's going to take even more. So these guys here that are running the Fed, you know, they got the right idea. They're not waiting until the train gets too much momentum here. They're propping the liquidity into these markets ahead of time, trying to slow the train down. But this train's already got some speed. So you say, how is this going to affect the economy in the future? I see this huge injection of money. Huge. This is huge. This is by the time this is done at $75 billion a day, and it's going to extend way out into October, day after day after day after, I mean $75 billion a day adds up quick. Okay, this is going to be hundreds of billions of dollars injected, fresh money injected into the economy. It's going to filter its way down through the economy over the next number of months. But it is going to dry up at a certain point. What this is basically effectively going to do is it's going to start to stave back this and lowering interest rates too is going to stave back the United States from falling into a recession a little bit longer. It's not going to stop it. It's not going to stop the United States from going into a recession, but it's going to push it off a little bit further than these other countries. What's going to happen is these other countries out there, like Italy, you know the ones, China, Italy, Germany, the United Kingdom, they're all going to start heading into recession. When they head into recession, then they're going to open up their money, their floodgates of money. They're going to open up their central banks. They're going to start trying to get out of the recession in their countries as well. And basically what this amounts to is all the central banks on Earth going into what I call the Great Print. The Great Print just begun. This is why this is a game changer. This is the Great Print. I've been talking about this for ages, saying it's coming. It's begun. It's just begun under my nose, right there. Bang, binga, banga, banga. $75 billion a day. That's the Great Print. It's beginning. It's beginning. It's in its initial phases. It's going to intensify over the next year or two. It's going to lead to stagflation, and the reason why is because this money's not making its way into the main street. This money is all going to the big boys, right? We're still going to be living in poverty, and we're still going to be living in conditions where we can't afford to buy that steak dinner, right? And so our spending is going to be down, while their spending is going to be up. it's going to create something called stagflation. That's where they're printing the money, prices are rising, but your wages aren't going up. And it's the worst of all worlds, stagflation. It's a stagnant economy with inflation at the same time. It's a middle hands of the middle class and redistributes the wealth to the wealthy. It makes them richer, makes us poorer. This is what this amounts to. And you know, I don't know how long this is going to continue, but this is going to move toward a hyperinflation, because ultimately what happens is they keep having to print more and more and more and more, and in the end, it just the purchasing power of your dollars is not much, and you see it going down monthly, and you decide, well, I'm going to splurge. You know, I'm going to take my money out of the bank. I'm going to buy something now, because 6 months from now, it's going to be twice as costly. And so everybody starts thinking the same way at the same time. When that phenomenon occurs of everybody thinking the same way at the same time, that's when the hyperinflation begins. And I figure it's maybe another 2 years away. They've been able to kick this can down the road for a long time. I can see this recession starting in America last. The recession hitting last. And what's going to drag America into the recession is when these other countries start to go into recession. They're going to drag America down into a recession too. But I'm thinking that we're going to last a little bit longer, especially because of what's just happened. So I'm having to change my whole way of thinking. You have to be flexible in this world. When something happens that's this big, this momentous, is all of this billions and billions of money that are dumping into the market right now, you have to be flexible and adjust your way of thinking really quickly to what's happening. And I can see this pushing the recession off until next summer. I still don't think we're going to be able to push the recession off until the election cycle is over. But I can see it lasting until next summer before the recession really gets underway. But in Europe and these places like Germany, I think the first quarter I think Germany's going to be in a recession by the first quarter, you know? And I think that the United States economy is going to feel the effects of this amount of money. This is huge. Listen, thank you guys for listening. Like and subscribe, and we'll catch you guys in the next market report. Give me a thumbs up, guys. It means a lot to me. Bye-bye.